A financial war most Americans don't see. Imagine this. You wake up one morning, turn on the news, and suddenly everyone is talking about a financial emergency. Stocks are sliding. Gas prices spike overnight. Mortgage rates jump again. The dollar is weakening. And the scary part? There wasn't a cyber attack. There wasn't a terrorist incident. There wasn't even a traditional war. Instead, it started with a decision made quietly in Beijing. Because right now, behind the scenes of trade wars, tech wars, and military tensions, a financial Cold War is unfolding. And one of the biggest battlefields is the US dollar itself. China, America's biggest strategic rival, has been slowly reducing its reliance on US dollars and Treasury bonds. Some analysts call it diversification, others call it preparation, and some call it economic warfare, especially in a world where tensions over Taiwan, sanctions, supply chains, and global influence are rising. Former President Donald Trump has repeatedly warned about China's economic power, trade imbalance, and manufacturing dominance, making this issue even more politically charged in the US. So the real question isn't just, is China dumping dollars? Is this backhand index pointing right if the world's second-largest economy stops needing US money? What happens to America? 2. Why the dollar is America's ultimate weapon. Most Americans think military power makes the US a superpower. But financial power may be even more important. The US dollar isn't just a currency. It's the backbone of the global economy. Around the world, dollars are used to buy oil and energy, settle international trade, pay off global debt, stabilize national reserves, conduct cross-border banking. About 60% of global foreign exchange reserves are held in dollars. That means countries trust US money more than their own. Economists call this advantage exorbitant privilege. It allows America to borrow at lower interest rates, run massive deficits, print money during crises, fund military operations cheaply, impose powerful financial sanctions. When the US sanctions a country, it can cut them off from the dollar system, essentially freezing them out of global trade. This happened to Iran. It happened to Russia. And China is paying very close attention. 3. How China ended up owning so much US debt. China didn't just buy US debt for fun. It was the result of decades of economic interdependence. For years, the arrangement worked like this. America consumed. China produced. Americans bought everything from electronics to furniture to clothing. Those purchases sent trillions of dollars to China. Instead of spending all that cash, China reinvested it into US Treasury bonds, considered one of the safest assets in the world. At one point, China held over $1.3 trillion in US government debt. In effect, China helped finance American spending, including infrastructure, social programs, and military budgets. It was a strange relationship, economic rivals, but financial partners. For the shift, China is quietly pulling back. Over the past decade, China has gradually reduced its holdings of US treasuries. Not dramatically, not suddenly, but consistently. Why? Because the global environment has changed. Trade disputes escalated during the Trump administration. Tariffs reshaped supply chains. Technology restrictions intensified. Military tensions in the Indo-Pacific increased. And sanctions against Russia showed how powerful and dangerous dollar dependence can be. From China's perspective, holding too many US assets could become a vulnerability in a future conflict. 5. Sanctions changed the game. When Russia invaded Ukraine, the US and its allies froze hundreds of billions of dollars in Russian foreign reserves. That move sent shockwaves through central banks worldwide. It demonstrated that reserves held in Western currencies could be rendered unusable overnight. For countries that might one day clash with the US, that's a major concern. China, as a potential adversary in a Taiwan scenario, is particularly sensitive to this risk. Reducing dollar exposure becomes a form of insurance. 6. China's massive gold buying spree. Instead of treasuries, China has been accumulating gold at a rapid pace. Gold offers several advantages. cannot be frozen by another government. It retains value during crises. It does not rely on any single country's economy. It serves as a hedge against currency instability. Central banks worldwide, especially in emerging economies, have increased gold purchases. This trend suggests a gradual shift away from dollar-centric reserves. 7. The push for a de-dollarized world. China isn't acting alone. Several countries are exploring ways to reduce reliance on the U.S. financial system. Efforts include trading oil in non-dollar currencies, creating alternative payment networks, expanding bilateral currency agreements, strengthening regional financial blocs. Some of these initiatives involve the BRICS group of nations, which seeks to increase economic cooperation outside Western institutions. While these alternatives are still small compared to the dollar system, they signal a long-term strategic shift. 8. What if China sold U.S. assets aggressively? A sudden large-scale sale of U.S. treasuries by China could trigger significant market volatility. Potential effects include bar chart rising interest rates. Reduced demand for bonds would push yields higher. Higher yields translate into higher borrowing costs across the economy. Housing pressure. Mortgage rates are closely tied to Treasury yields. Higher rates reduce affordability and can cool housing markets. Chart decreasing stock market stress. Higher rates increase corporate borrowing costs and reduce valuations. Fuel pump inflation risks. A weaker dollar raises the price of imported goods, contributing to inflation. 9. Why China can't fully weaponize the dollar issue. Despite concerns, China faces constraints. Dependence on U.S. consumers. The American market remains one of China's largest export destinations. A U.S. recession would harm Chinese manufacturing and employment. Chart decreasing self-inflicted losses. Selling large bond holdings quickly would depress prices, reducing the value of China's remaining assets. Lack of alternatives. No other currency currently matches the dollar's liquidity, stability, and global acceptance. 10. The most likely future. Slow transformation, not collapse. Rather than a sudden dollar collapse, experts expect a gradual evolution toward a multipolar financial system. In this scenario, the dollar remains dominant. Other currencies gain modest roles. Gold becomes more important. Regional trade increases. Financial competition intensifies. China reducing dollar exposure does not mean an imminent economic disaster for the United States. However, it reflects a broader shift in global power dynamics. In an era defined by trade disputes, technological competition, military tension, and political polarization, including debates shaped by leaders like Donald Trump, financial strategy has become another arena of rivalry. For Americans, the implications are indirect but meaningful. Interest rates, inflation, investment returns, and economic stability are all influenced by global demand for U.S. assets. The financial war isn't fought with missiles or tanks. It's fought with currencies, bonds, trade agreements, and strategic reserves. And it may shape the economic landscape for decades to come.